Yeah. So this session is on now banking fundamentals. Now the topics are all given. I mean, they also took a session. It's all theoretical sessions, but unless you have a proper understanding of banking and how banking works, on the spot, if they give some questions or if they twist the questions, it would be difficult for you to think and answer. So I thought I'll give you a brief about how this banking and the lending process works. I don't know whether you went through the YouTube videos or not, but still I will quickly cover up. We have limited time. Now, so banking is like, banks borrow money. Banks borrow money from, I mean, I wish you would take notes. I'm recording the session. I don't know whether will I get time to upload it in YouTube and then leave. I'll see what best I can do. Then, yeah, so banking is like banks borrow money from the general public at a particular rate of interest. Say, for example, savings bank interest, 2.5%, 3%, 3.5%. And then they lend this loan to somebody who is in need of money at a higher rate of interest, say 8.5% or 12%, 14%. Or if it's a personal loan, like say 24%, 36%, they lend. And the difference between the lending rate and the rate at which they borrow the money from general public, which is the deposit rate, we call it. So that is called the net interest margin. So that's what the margin, like the profit margin for the bank. So in a bank, there is no inventory. Cash itself is the inventory. So they trade in cash. They get cash from one place and then they sell cash to another place at a higher interest rate. So that's how the banking works. So ANZ is also a bank, and you guys are going to be part of the lending part of the bank. So in any bank, there are two extremes. One is where the bank borrows money from the public in terms of deposits. So either you will be part of the team which accumulates deposits from the public, or you will be with the part of the team which gives loan to the public. Okay, so in ANZ for this role, it's very clear that you are going to be part of the bank, which is the lending arm of the bank. So for a bank, they have products which are grouped as deposit products and lending products. So the deposit products are the money which are collected from the general public. So it's not bank's money. Bank never lends its own capital. Bank borrows money from the general public. That money is lent to again back to the public who are in need of money. So the deposits which are accumulated from the public are liable to be paid to the public whenever the public demands, either through a check leaf or through a demand draft or through ATM or online payment. No, whatever way the public is demanding, the bank supposed to pay back the money to the depositors. So that's why all the deposit products for a bank, from the bank's perspective, all the deposit products are called as liability products because bank is liable to pay. It's not bank's money, it's public money which is received. So it's all payable back to the customer. So it's all called as the liability products. Whereas the loans which the bank lends to the general public, the loans which the bank lends to the general public, which are income generators for the bank. There are different sources of income for a bank. One major source of income for a bank is the interest income. So the public who borrows money from the bank, they are supposed to repay it. When they repay the money back to the bank, they pay the principal along with the interest they pay. So the interest what the bank receives is part of the revenue. So all the lending products of the bank are called as the assets of a bank because those are the loans are the products which are going to generate income for a bank. So all the loan products are called as the assets of the bank. Okay, so usually what happens if you take a company's perspective, if the company borrows money from a bank, for a bank, that money is called a liability. But for a bank, it is the other way around because bank doesn't lend money from its own, but it is lending the customer's money and then generating income out of it. So all the lending products are called as the assets of the bank, and all the deposit products of the bank are called as the liability of the bank. So if a bank takes a loan from RBI or from an external agency, that would come under the liability of the bank. So you need to clearly keep this in mind. Only two categories of products in a bank. One is called as deposit products, which are called as the liability products. Another thing is called the lending products, which are called as the asset products. That's why NPA, we call it as non-performing asset. Non-performing asset denotes a loan where principal and interest, from Indian perspective, for a loan where interest and principal is not received for a period of 90 days. That's why it's called as non-performing asset. Why a loan is called as a non-performing asset? Because all the lending products will come under the assets of a bank. And if you take the lending products, two broad categories. Today morning also they are briefing. One is called as secured loans, another one is called as unsecured loans. So any loan which is backed by a security, collateral security, we call it as a secured loans. And then any loans which doesn't have a collateral security, we call it as unsecured loan. So generally with Indian perspective, any secured loan, for example, like say home loans, mortgages, car loan, auto loan in the sense, passenger cars or commercial cars, or it could be say commercial vehicles like trucks or big earth moving machines like cranes or bulldozers. All these loans are backed with asset. Even gold loan nowadays, loan against shares, securities, loan against mutual funds, all these things has got some collateral security, either financial security or it could be a non-financial security like a building or a machinery or a plant. Okay, so all these are secured loans. Now there are unsecured loans. Unsecured loans usually not backed by a collateral security. So the unsecured loans example are in Indian perspective, for an individual perspective, we have the personal loans, credit cards. For a business perspective, we call the same personal loan. We don't call it a personal loan, we call it a business loan. So usually compared to the secured loan, the unsecured loans, the tenure will be very short because there is no collateral security. Whereas a home loan in Indian perspective, it could range from say 10 years to 30 years. Even you can have a home loan for 30 years because there is a collateral security and it's an appreciating asset as well. So banks are comfortable lending you against a home, for a home loan. And in India, the real estate sector is also growing. So they are okay with that. But when you take a personal loan, no bank will give personal loan for 30 years or 20 years or 15 years. Because there is no collateral security over there, and there's always a risk. Many kinds of risk is there if you give a unsecured loan for a long time. So usually the personal loans are issued for 12 months, 24 months, 36 months, maximum 5 years, 60 installments, 60 months. So it goes like that. And the credit card is also another product which is unsecured. So for the business also, they provide the same personal loan, which is called as a business loan in India. Even that is a short term. So that is one difference. Like the secured loan, usually the tenure is long. And then for an unsecured loan, usually the tenure is very short. And for collateral security, since the bank has got a security already there, the lending rates for secured loans are comparatively less than a secured loan. Secured loan, as there are no collateral securities, bank usually charge a premium, very high interest rate they charge. And so nobody will go for a personal loan. Anyone will go for a personal loan only for an emergency. Say, for example, they have a marriage expense or they wanted to buy something urgently to meet some urgent requirements. So usually in India, like 25,000, 50,000, 1 lakh, 2 lakh, 3 lakh, 4 lakh, 5 lakh, like that. The amount also will be less compared to a home loan. Whereas a home loan, you will take for 1 crore, 3 crore, 4 crore, 5 crore, depending on the property. But then for a personal loan, nobody will get for 1 crore to 10 crore like that. Nobody will give. So the loan rate, loan volume, the size of the loan also will be less. At the same time, interest rate will be high for a secured loan because bank doesn't have any collateral. The bank is facing the risk actually. The bank is actually taking the risk on its own. So the bank charges extra this one. And why would a customer would pay 24% or 36% for a personal loan would be interested? Because of the emergency. So who will go for a loan? Somebody who's in emergency will go for a personal loan and who's willing to pay that much of interest because he has got an emergency. Second thing is who doesn't have a collateral security, but very urgently requires the money. If somebody has got a collateral security, will mortgage the property and then they will get a loan. Or if it's a gold kind of a thing, they may pledge the gold and they may get a loan for that. So somebody who doesn't have all these things would go for a personal loan and would be willing to pay that extra interest as well. So this is the personal loan and I mean, the unsecured loans are different from the secured loan. For both secured and unsecured loan, it will be fixed rate or floating rate is decided by the banks and agreed upon by banks and the borrower and the lender. And this may vary from countries to country. So the customer can choose at the time of applying whether they want a fixed interest rate or the floating rate. So floating rate, for people who do not know, the fixed rate is for a period of the entire tenure of the loan. The interest rate will not vary. Say, for example, you take a loan at 10% and you have a repayment tenure of 60 months, which is 5 years. Entire 5 years, the interest rate will remain the same 10%. But we know that how RBI, the central banks work. They keep on changing the interest rate up and down to control the money supply and the inflation rate, the prices of the products. So according to the RBI's or the monetary policy rates, the banks would also change their lending rates and the deposit rates. So what happens sometimes, the banks would offer the loans at a flexible rate. So the customer's choice in India, floating rate we call it. So customers can opt for a floating rate. But the risk is, if the floating rate, the interest rate comes down, it's good for the customer. But what if the interest rate goes up? Then that will be a burden for the customer. So when would a customer would go for a floating rate is if the interest rate is already high and they're expecting the rate cuts. At that time, a prudent customer will go for a floating rate. A non-prudent customer who is not knowledgeable that much would not even know what's the difference between a floating rate and a fixed rate. But having said that, when a customer opts for a fixed rate, banks are smarter. A fixed rate loan generally would be priced higher than the floating rate because the floating rate may go up and down. So banks also will buffer that risk. So when they go for a fixed rate, they will price it a little bit higher than the floating rate. So when they go for a floating rate, there's a chance that interest rate may go up and down. If the interest rate comes down, it's good for the customer. If the interest rate goes up, it will strain the customer for the repayment. Anyway, we'll cover that a little later. So, but this is the thing you need to keep in mind. So our this one, for this particular role, only 2 products under consideration. One is personal loan and second is the credit card. So first, the personal loan, as I said, message me that you keep it here. So one is the personal loan, which we discussed already, unsecured loan. So usually in India, the customer applies for a loan through an application form. Usually the loan application is not like the other application, like it's an agreement. We call it as agreement. So along with the application, for the application form, will collect the basic KYC information like the name, date of birth, husband name or mother's name, contact number, email ID, where are you working, monthly income, annual income, so all the KYC, which is, so KYC means you think mostly it is the documents. It's not just the documents. The entire application form itself is part of the KYC only. Along with the KYC application form, they will also get an agreement which is signed by the lender and the borrower, and that agreement will have all the terms and conditions of the loan. So only they sign that. So what are the documents they collect? They collect all the ID proof, address proof, photograph, signature proof of the customer. On what basis they give the loan? On the basis of their income, how much income they generate. Based on that, they, banks fund the loan. So there is no collateral security to assess. So purely based on the income. So in the unsecured loan, as I said, the bank faces a huge risk. Like if there's a default, the bank doesn't have any hold on the customer to say that, if you don't pay, I will seize your property. So it's a high risk for the bank. So the bank charges a premium, higher interest rate. Now then, what critical for the bank is to make the right decision, to choose the right customer to whom you will fund, how much you will fund, at what rate you will fund, are very critical decisions before they give the personal loan. You cannot give personal loan to everyone. A lot of things are considered while approving a personal loan. So that's why you will learn that 5 C's. Okay, so we'll talk in those lines only. So the first one is whether the customer has got a repaying capacity. So how do they assess? Is they assess based on the income. So you have a requirement for 1 crore rupees, but I cannot give a personal loan for 1 crore rupees. I need to find out whether you have the capacity to repay it. So what do you mean by capacity to repay it? Now I will give you a loan today, say 5 lakh rupees personal loan, I'll give you today. So it's cash inflow for you. But how will you repay it? You will not repay me 5 lakhs immediately. You will repay me in 60 installments every month. You may pay 10 10,000 rupees and you may pay it for 60 installments, 10 or 12,000 rupees, you may pay it for 60 installments. So you will make periodic payments. So then the longer the tenure, the risk for the bank is higher as well. So the decision is very critical. So how they do it is, so they check your income. So how much income you have. So you are asking for 5 lakh rupee loan, and then when the EMI repayment comes, whether you have sufficient income, because the EMI is monthly payment. So you are also a salaried person. Usually personal loan is provided for the salary person, not necessarily even for a businessman we can give, but in India we call it as a business loan. But it works the same like the personal loan concept only. So we need some document evidence. So we collect the KYC documents, like to prove that he is the person. Like suppose if you process my loan application, you do not know who am I. So I give you my government card, Aadhaar card, or this one to ensure that I am that particular person. So same way, apart from that KYC, the banker will try to find out whether you have an income. So they'll ask, where are you working? So the income, we need to find out where you are working. Second, how much salary you are getting monthly, because you are going to repay me on a monthly basis. So salary, document for evidencing the salaries in India, the payslip. Of course, in Australia, it's the payslip. And we can also get other documents like Form 16, which is like which will show the income and the taxes paid, or the ITR, like once you file the tax, where you calculate the total income and then you calculate the income tax and you file how much income tax you pay, all these things. So all these documents will help us to assess how much is the income the person is getting. So it's not just about the income. So I'll give you situations like, say, for example, I get 50,000 rupees a month, and then I ask for a 5 lakh rupee loan. Now, personal loan, usually like per lakh for 60 months installment for per lakh of loan, maybe you have to pay an EMI of say 3,000 or 4,000 rupees per lakh. So 5 lakhs means 5 into 4,000, 20,000 rupees EMI I have to pay to you if you give me 5 lakh rupees ka loan. So my monthly income is 50,000 rupees. So the capacity, how the bank assesses it is, so the income of the person is 50,000. In that 20,000, he has to pay as EMI. So whether he will be able to pay that 20,000 or 50,000 as a EMI to me or not. For that, what they try to understand is, the questions what the banker will ask is, do you have any existing loan? Because if you have an existing loan, you will have to pay EMI already to another lender. So suppose if I already have a car loan where I am pay every month 15,000 rupees as EMI. So what happens? 50,000 they will not account into the calculation. They will reduce that. Already my commitments are there, installments are there. So 15,000 they reduce. So only 35,000 is remaining, which is available for repayment of the personal loan. But even that is not considered, because if I am a family man, like I myself, my wife is not working, and I have a child who's studying in the school, it means I have other living expenses as well. So in India, usually the thumb rule is 50% of your income is required to meet your monthly expenses like khana, food, to pay your rent, all this stuff. Usually there is an assumption, okay, in India. But in Australia, they collect document evidence for each of these things. So say we'll go with Indian thumb rule, say 50%. It means 50,000 may 50%, which is 25,000. So already 15,000 I am paying car loan. 25,000 is required for my living expense. Living expenses, rent, food, school fee, van fee, all this stuff. So 25,000 plus 15,000, which is 40,000 already over. The remaining how much I have? 10,000. But how much is my EMI commitment? 20,000 for 5 lakh loan. So what the bank will do is, bank will say that you don't have the capacity to pay because you have your uncommitted income is only 10,000. So 10,000, how much loan I can give? Half of what you asked, which is 5 lakhs, because for 5 lakhs, 20,000 is EMI. So the bank will approve only 2.5 lakhs because bank knows that I will not be able to pay, because it will be neck to neck for me, because my wife is also not working. So it means my income is the sole income. So what happens now? The customer will not get full amount like 5 lakhs. The credit manager will approve only 50% of the loan, because it's so clear that I already have 15,000 of car loan and then 25,000 of my house expense. So the remaining leftover money is only 10,000 rupees. So they try to assess whether you have the capacity to repay in this manner. So we need to understand, how much is the current salary, how much is the current commitments in terms of loans, and then other expenses. And then only you need to find out how much is the uncommitted income. And then from there, you need to find out whether he has the capacity or not. So in India, what happens? Usually the husband and wife, both they work. So if my income is not sufficient, if my wife is working, so what they will do is, bankers will do is, they'll take wife's income also. They'll consider family income. So in the loan application, my wife will also be added as a joint applicant, and they'll check whether my wife has got any loan, extra loan, whether she has got, whether any EMI commitment is there for my wife. If my wife doesn't have got any EMI commitment, say for example, my wife earns 40,000 rupees. So now we have 90,000 rupees of family income, wherein 50%, if you take say 45,000 goes as our expense, and then 15,000 car loan is there, 60,000. So remaining still we have 30,000 rupees, whereas loan commitment comes to only 20,000. So even after paying EMI of 20,000, 10,000 will be extra left out. So the bank would be very comfortable to lend such a proposition. And in the first case, the bank may not be very comfortable lending. So with regard to capacity, so in the interview, they will not ask, can you tell me what are the 5 C's? Can you explain? All these questions don't expect. So in the interview, they may ask, but then they will give you situations like this, where somebody is working this much Australian dollars they're earning. This is their current EMI. And then they'll ask you like, these are the current expenses they have. So in Australia, they have, school fees is there, the rental expense, lease expenses are there. People who have old parents, to take care of their old parents, old people are put up in homes, so their expenses are there. So all these commitments are there. So we need to ensure that all these things are accounted, and you find the capacity, real capacity, and then you make a decision whether you will give loan or not. So questions will come using capacity as a concept, capacity as a criteria. So how you are able to assess it and make a decision, and how you will communicate it to the customer that whether your loan is rejected or you wanted this much, whereas only 50% is possible. So how you would communicate politely to the customer. So all these things matters. Okay, so all these things will be assessed during your interview. Now, second thing is called as a credit. Okay, now before that, I'll ask you a question you have to answer. There is a person who's working in a listed company, and he is earning 50,000 rupees salary a month. There is another customer who's applying for a same loan, personal loan, same amount. He is working in a supermarket, not a chain supermarket like DMart. It's a standalone supermarket in a place like say Bhairathi. So he is working there. He is also earning 50,000 rupees as a store manager. Now, which customer would you be comfortable lending?
The customer who is working in the listed company.
Why?
Because they have a stable income, and the supermarket guy has a income based on his working hours. That is, he has logged in.
Exactly. So on the spot, they'll give you these kind of twists. So you need to, think like a credit manager. You need to think like a banker only, and then you need to understand. It's not that bank money you are lending. You are lending public money. Okay, it should be like you should think like as if you are lending your own money, and then you should take the decision. Okay, that's a good one. Okay, so the stability of the employer is important, because once if that person closes the retail store, this person will lose a job and he will not pay. So loan will become bad loan. And then if you go and ask for collections, if you go and ask the customer, person to repay the loan, he will simply say that, my employer is not paying me salary. He closed down the company. So I'm jobless. I don't have income. So I'm not paying. So the stability of the employer is also matters. In India, they look at all these things. Okay, now fine. Another situation I'll give you. A person is earning, a woman who's earning, say 40,000 rupees, she's earning. But then she is newly married and she is on a maternity leave. Okay. Will you lend her a loan or not?
It is hardly unlikely I will lend her a loan.
Think. Okay. There's not always a yes or no question. Okay. You need to think.
So can you repeat the scenario once more?
A married woman who is applying for a loan, but she's currently in the maternity leave. She's newly married. She's in the maternity leave, and she's asking for a personal loan. Will you lend or not?
Yes, sir. We'll lend them because she's still getting paid during maternity leave also, right? So that's why.
But what's the guarantee that after maternity she will continue the job?
Exactly, sir. That's why I told I will not lend the loan.
No, but you need to just see. Don't give one word answers. Okay, you need to give your point of view also. Why do you
Okay,
say
sir,
that?
understood.
In the interview also, when you say yes or no, don't give yes or no. Try to
Sir,
speak.
I'll ask that lady whether she's going to continue the job or not.
So we need to assess that, right? Without that, we cannot say yes or no. Correct. So any question you cannot say yes or no. You need to have more information because which I did not give you, right? So you need to say in the interview, sir. I mean, if it is yes, under which circumstances it will be yes. If it is no, like that you explain. So that would show the interviewer that how much understanding you have. Now, when I say she's married, what else also can you consider? I mean, you will look at the employer stability.
Husband salary, sir.
Exactly. So she's telling she's married, and if they are living together, you can also take her husband's as a co-applicant, and family income you can take, and then still you can assess. But even in this case, I did not give you the full situation, like whether they have any existing loans, how much is there going to be requirements. Now, once she gives birth, I mean, their expenses will go up. Now, in the family, earlier it was only husband and wife. Now there's a third person. Okay, after that, the expense will go up to take care of the child, vaccines, to buy the dresses. I mean, take care of the child. Maybe they may appoint a servant. I mean, buy food for, I mean, the child food and all, the Cerelac, all this so much costly. Vaccines, all these things will be more expense now for the family. So a lot of things to consider. So you need to give a in-depth analysis and this one. Okay, so like this, they may give situations. So that is capacity. What is the next C?
Capital.
Capital. Okay, now capital usually here, I mean, for a personal loan, they will not consider. But if it is a, I mean, business loan or for any other loan, I mean, usually the capital is, I mean, capital is your money. Okay, what happened once ICC Bank, what they did was they gave initially when they started and then they were expanding terribly, I mean, like very aggressively. So what they did was they gave loan for two-wheeler loan for 1 rupee. So what you can do is you can go to a dealership, you can pay 1 rupee, you can get a bike delivered, and ICC will pay the loan, not to you. I mean, usually the automobile bike loans, the amount will not be paid to you because they will not be able to establish whether you got the loan and purchased the bike or not. So what they'll do, they will give the loan to the dealer. The dealer will submit, the dealer will give a delivery order, delivery slip, which has to be submitted to the bank, so that which is the evidence for the bank that dealer has delivered the product. Okay, so the money will go. So if it is a say 50,000 bike in those days, so 1 rupee the customer will pay, remaining 49,999 ICC will pay to the dealer. So the dealer will get the money. When will the customer pay to the banker? Like every month EMI they will pay. So people are very smart. They know that non-performing asset, like 90 days, if both interest and principal is not paid, only then the bank has a charge on the property. Bank will come and seize your bike. So what people did, they paid 1 rupee, got the bike, only working capital, they fill the bike, they use the bike, and they don't pay the interest. After 90 days, bankers will call, they will threaten that we'll seize your bike because you're not paying. And the people used to say, okay, come and take the bike, because anyway, their money is only 1 rupee. So nowadays, what ICC learned a big lesson over there. Even if you buy a home loan or stuff like that, I mean, your money will be involved there. So they will not give 100% of the loan, which is called loan to value, LTV, that is there in the notes in the formula. So 80% LTV means if the property, say, if you're buying a property 1 crore rupees, so the bank will not give 1 crore rupees loan. The bank will say that 80% LTV, meaning 20% you have to invest. So 20% is your money, means 20 lakhs. Now imagine, will you let go the property? Will you default in your loan? You will, because your 20 lakhs is also will go in the property. So you will not do. So depending on your credit score and stuff, for property, they will consider different things. They'll also, if the property is in a prime location, bank will be very happy to lend, because even if you default, the property price would have doubled, tripled, or 5 times more, it would have gone. But if it is in a faraway location where the property price are not moving, I mean, even there LTV will be higher, I mean lower, So they may give only 70% or 75%. So all these things will appear in the secured loans. Next to see.
Condition.
Condition also doesn't apply to a condition. In what ways the conditions may change? Okay, that concept you need to understand. Say for example, today, say if the customer has taken a floating rate, and if the interest rate increases, if the interest rate increases, what will happen is, say for example, I have taken 5 lakh loan and then I pay a EMI of 20,000 rupees for a tenure of 60 installments. And if suppose the interest rate increases, what will happen is my EMI will increase. So instead of 20,000, I have to pay 25,000 now, or say 30,000 per month now. So if my income has also increased, I mean, it will not strain because my income has increased. But there are many chances the income wouldn't have increased so much, but the EMI would have increased. Another thing is my household expenses could have increased because maybe, as I said, a newborn baby might be there, things might be there. So expenses would have increased. So this will create unnecessary stress on the borrower. So what he will do is he will not give up on food, he will not give up on rent, he will give up on loan EMI payment. So when the interest rate increases, there is a chance that default may happen. So they try to stress test. So they will not fully utilize. So they'll keep a buffer. Okay, if there is an interest change, how much the EMI can go up, and if that EMI goes up, how much stress the borrower will be able to take it. So all these things they try to do it, and then only do. Alternatively, what banks do, they restructure. That's the term is called as restructuring of loan. What do you mean by restructuring of loan is the bank does help the customer in those situations where interest rate goes up, whereas it puts stress on the borrower. The borrower, once who's regularly paying, now is not able to pay because the interest rate has gone up. So what the banker will try to help the customer is, see, now interest rate has increased. Because of that, your EMI burden has increased. So what we'll do is, I'll give you extension 1 more year. Means earlier you had 50 installments. Now you have already completed, say, 12 months. So remaining 48 installments is pending. What I'll do is, instead of increasing the EMI, I'll keep the EMI constant. Instead, I will increase the tenure by another 1 year, 12 installments. So here, instead of increasing the EMI, the tenure will be increased, but the EMI will be kept constant. So it will not put burden on the borrower, but the borrower has to pay for another 12 more months. I mean, definitely bank will get their interest, what they're supposed to get, but it will go on a monthly basis. So it will not strain the customer. So in those cases, the condition is very, very, very important. Next to see. Character. So why character is significant here for a secured? Character is significant, but both secured and unsecured loan. But for unsecured loan, character is very, very important. Why?
Because
Right,
to
assesses
know his credit behaviors, like credit score or like past history of buying loans or repaying loans or something.
Yeah. See, a person who's defaulting, could default on many situations. Suppose somebody, a income earner in a family, somebody who died. Say for example, 2 people, husband and wife are there, and if husband dies, the woman alone has to now run the family. She may not be able to pay this one. So there's a risk to life. Usually banks, nowadays they take insurance, they cover it, so that if the person dies also, the amount will be secured. So even understand this, even if the person dies, if it is a joint loan, the other person has to pay. If it is a secure loan and if the person dies, still the bank will seize the property unless a family member pays it. Okay, so that life risk, they take it using the insurance. Job loss could also trouble. So a default, the point I'm trying to make is, the default could be willful default, or it could be purposeful default. Not purposeful. It could be situational default. So they call it a willful default. Willful default is because of the character. Okay, so many times in India also, many people, they took this one. People will call, when the recovery people call, they will call because they have given the loan, right? They will talk like a master only, they will talk. And these people will say that, okay, I also have gundas. Okay, you bring gundas, I will also bring gundas. I won't pay the loan. So this is a character, attitude. So they check how do